The sucker effect is a psychological phenomenon that refers to the tendency of some individuals to continue investing in a failing project or endeavor, even when it becomes clear that the situation is unlikely to improve. This behavior is driven by the fear of feeling like a sucker or a fool for having invested time, money, or effort into something that ultimately turns out to be unsuccessful. The term sucker effect is often associated with the concept of sunk costs, which are costs that have already been incurred and cannot be recovered. People tend to feel a strong emotional attachment to these sunk costs, leading them to irrationally continue investing in a failing venture. They fear that if they abandon the project, they will have wasted their initial investments and will be perceived as foolish for doing so. In economics and decision-making psychology, this behavior is considered an example of irrational decision-making. Instead of objectively evaluating the future potential of the project, individuals are influenced by their emotional attachment to the past investments. The sucker effect can lead to significant financial losses and missed opportunities for more productive investments. One real-life example of the sucker effect can be observed in the stock market. An investor might purchase shares of a company based on positive expectations and the hope of making a profit. As the stock price starts to decline, the investor faces a dilemma. If they sell the shares, they will realize a loss, which can be emotionally distressing. They might hesitate to sell, hoping the stock will rebound, even if there is little evidence to support this belief. As a result, the investor might continue holding on to the failing investment, ultimately suffering more substantial losses. Overcoming the sucker effect requires individuals to detach emotionally from sunk costs and make decisions based on objective analysis of future prospects. This can be challenging, as our emotions and cognitive biases often cloud our judgment. Strategies like setting predefined exit points for investments, seeking advice from impartial sources, and conducting regular evaluations can help counteract the sucker effect. Additionally, being aware of cognitive biases and psychological traps can aid decision makers in recognizing when they are falling into the sucker effect. By acknowledging and understanding these biases, individuals can make more informed and rational choices about how to allocate their resources and investments. In conclusion, the sucker effect is a psychological phenomenon where individuals continue investing in failing endeavors due to emotional attachment to sunk costs. This irrational behavior can lead to significant financial losses and missed opportunities. Recognizing and overcoming this effect requires objective evaluation of future prospects and detaching emotionally from past investments. Awareness of cognitive biases is crucial in making more rational and informed decisions.